I'm not a mortgage broker, but if I were, I'd probably be the best. Today, we're going to be talking about rates, and if you've never seen any of my content before, I think the government will be mirroring the US and dropping rates quickly. If the Bank of Canada only cuts once this year, the payment relief that you're hoping for won't be as big as you think. I'm going to break down what that actually looks like on a typical renewal, variable rates, and why the bigger story right now is fixed rates slowly drifting while inventory piles up in Calgary and Edmonton. Today's about where rates are heading in Canada and what that means for buyers, owners, renters, and investors. I'm gonna call it straight, map out the upside and downside, and give you moves that you can use this week. My anchors here are the latest Metro deep dive on housing data and the Bank of Canada's most recent decisions. The policy rate is 2.75%, and we've held that since March. But the Bank of Canada kept circling one word in their latest report, which is uncertainty. It's their way of admitting that they're stuck between a weaker economy and tariff pressure pushing up import prices. In plain English, they want to cut, but they're scared of cutting too fast and waking inflation back up. Job growth has cooled, private payrolls are fading, and long-term unemployment is definitely climbing. That takes pressure off of wages and inflation. So we're in a holding pattern for a couple of meetings, then likely back to easing if the numbers give them room. Let's go over 3 different scenarios, and this is my base case. 2 to 3 quarter-point cuts between late this year and early next. That means variable relief shows up gradually, not in a big rush. Fixed rates drift lower with bonds, but they don't collapse. Housing stabilizes in 2026 once today's supply gets eaten up. The upside scenario, tariffs don't hurt us as much as we originally thought, global growth holds, and the Bank of Canada starts cutting earlier. If they sneak a cut in September and another in December, variable payments step down sooner, 5-year fixed edges lower, renewals feel lighter, and buyers stop sitting on their hands. And 3 rate cuts before the end of the year is not out of the question. The downside scenario that you might be seeing all over the news, tariffs push prices up, headline inflation pops for a couple of months, and maybe the Bank of Canada delays doing any rate drops until the new year. Fixed rates could stay sticky, the dollar sags, and renewals stay rough. But if you're up for renewal within the next year, plan for this as the baseline and treat any earlier cuts as a huge bonus. Toronto just posted its biggest monthly sales jump in 9 months. It was up 13% from June, but benchmark prices are still slipping and it's down year over year. Translation, activity is back before prices are. Buyers with patience win, sellers anchored to pandemic peaks are going to lose. But what does this mean for your payments? And let's be real, if you're renewing in the next 6 to 12 months and we only see 125 basis point cut, the difference in your monthly payments is noticeable, but not life-changing. What really matters is your amortization that's left and whether your lender will extend it and the spread you negotiate. Here's a playbook for anyone looking to renew. Step 1, get your current lender's internal quote and a written rate hold. Step 2, grab a competitive written quote from a broker with all the fine print terms, including switch costs spelled out. Step 3, please just use a broker because they can usually beat the rate or at least get you better terms. Step 4, if cash flow's tight, extend your amortization, but commit in writing to make quarterly prepayments so you don't drag it out forever. You really have to watch these rates and some of the specials that pop up. 1 cut helps, 2 cuts help a lot more, but the spread that you lock in helps the most. When it comes to Toronto real estate, sales are up, but there are a ton of listings, and the sales to new listing ratio is in the 30s, so we truly are in a buyer's market. July's median sold prices dropped, and sellers are finally starting to wake up. This is where patience pays off. Buy properties that rent easy on streets with real comps and negotiate terms that can help cash flow in year 1. Vancouver is essentially in the same boat as Toronto, but with a different backdrop. Activity is starting to tick up, but inventory is still way too high, especially in the condo market. If the rates ease as expected, you get stabilization first, not a boom. So if you're a buyer, negotiate now, and you're going to be a lot safer when the market recovers in the next year or 2. When we're looking at Alberta real estate, Calgary and Edmonton specifically, Edmonton is still hot. Prices are up year over year, and we're still leaning into a seller's market. Calgary, on the other hand, oversupply, listings keep climbing, benchmark prices down on the year. Now, this won't last forever, but it does give patient buyers a real shot at purchasing a great home for a reasonable price. If you're upgrading Calgary, the spread between what you sell and what you can buy work in your favor while inventory is fat. That with an F, not a P. Rental supply is flooding Toronto, Vancouver, and Calgary. Condo completions plus new rental builds are stacking up and landlords are dangling incentives. Investors need to model conservative rents long-term and ideally get some longer leases so the deal still works if vacancy drifts higher. One of the main reasons that we are seeing the Calgary apartment and townhome resale market flood is because of the out-of-town investors. We saw a flood of investors from 2020 to 2023, and now that all of the pre-cons have been built, everyone's listing them, and I have seen countless investors taking a massive hit just to try and sell or trying to get an assignment sale, which is essentially selling the rights to buy the home or just selling it before taking possession because they can't afford to take possession anymore. Renters, you've got a lot more leverage than last year, but you have to be reasonable, be factual, and negotiate a term, not just the price. Offer a longer lease for a lower monthly or renewal formula that caps increases. Landlords have to be smart right now, and you need to stay sharp from day one and make the listing stand out. Offer 2 or 3 small concessions that boost your response rate. Flexible start dates, pet-friendly, a professional clean at move-in. Better to rent in 1 week at a 98% ask than sit empty for a few months and then get grinded all the way down. Pre-con condo sales have been in the basement for a year and the math just doesn't work yet. This is going to set up a huge bull run in early 2030s, but not in 2025. In single family, watch permits. BC permits are scraping lows, and that's your signal that detached supply will be tight later on. If the base case holds, single family is going to stabilize first, then condos once absorption improves. But remember, we're talking years in the future, not months. When we look at the macro, the labor market is definitely softening. Private payrolls are weak, long-term unemployment is rising. Wages cool, inflation cools. For business owners, that means that you can hire a bit easier, but you should also carry extra liquidity because there's still a lot of unknowns. All right, if you've made it this far, you clearly are into this content, so do me a favor. Hit the like button, helps more people see this. And if you want more straight to the point real estate insights without the fluff, make sure to subscribe. I drop videos like this often, very often. I'd actually drop it more if I had more subscribers, so thank you for subbing. Okay, now it's time for a quick rapid fire Q&A for my last Instagram poll. Question number 1, should I jump into a variable rate now? Well, I don't know your situation, and again, I'm not a mortgage broker, but only if your cash flow can handle the noise and your spread beats the best 3-year fixed is what I would assume a mortgage broker would say. Question number 2, will fixed rates crash after the next cut? My opinion, no. Think drift, not dive. Bonds lead mortgages, not the other way around. Question number 3, is the Canadian dollar a problem? Well, a weaker dollar isn't automatically bad. It actually helps Canadian businesses sell stuff abroad because their products look a lot cheaper to buyers in other countries. But it also makes anything that we import like food, clothes, electronics more expensive here at home. Okay, last question. What if tariffs spike? Well, if tariffs spike, then the Bank of Canada is probably going to wait and relief is probably going to move to next year, but plan for that as the baseline and treat anything else as a gift. In my opinion, the base case, we're probably going to see 1 or 2 small cuts with a small chance of a 3rd cut late this year or early next. This might be enough to take the edge off of renewals and lay the floor under housing by 2026. The upside is earlier cuts. Downside is a slower grind with sticky fixed rates into winter. Either way, you win if you plan. All right, your next 3 moves. If you're renewing the next 6 to 12 months, get 2 written quotes this week and push for total costs, not just the headline rate. If you're shopping for a new home, pick 3 neighborhoods in your budget and learn every comp so when one pops up that meets your criteria, you can jump on it. If you're looking to invest, underwrite with conservative rents and stress test assuming just that 1 rate cut. And if you get 2, it's a deal.